let's talk about REITs, real estate investment trusts. They kind of seem like the perfect investment, right? You get a slice of the real estate market, and you often see these absolutely jaw-dropping dividend yields. But whenever you see a stock dishing out, say, 10, maybe 15%, you've got to ask yourself a really important question. And that's exactly what we're going to dig into today. So, is that flashy double-digit number a golden ticket, or is it just a well-disguised trap? It's that classic investor's dilemma, isn't it? High reward versus high risk. And today, we're just going to let the numbers do the talking. So, here's how we're going to break it all down. First, we're going to look at the two main types of REITs. I like to call them landlords and bankers. Then, we'll dive into why one is just so much riskier than the other. After that, we'll put their long-term returns head-to-head, and we'll wrap it all up by figuring out which one, if any, actually fits your personal strategy. Okay, first things first, you gotta understand that not all REITs are built the same. Not even close. They basically operate in two completely different ways, and the easiest way to get it is to think of them as two totally different jobs. You've got your landlord, and you've got your banker. So what is a REIT really? Well, at its core, it's just a company that lets you pool your money with other investors to own a bunch of properties. Kind of like a mutual fund, but for buildings. But, and this is the key, the way they make their money is what splits them into our two camps. And this slide right here, it lays out the two paths perfectly. On one side, you've got equity REITs, our landlords. They actually own the physical buildings and cash the rent checks. And yeah, they use some debt, but it's pretty modest. Then on the other side, you've got mortgage REITs, or M-REITs, our bankers. Now, they don't own any buildings. They own the debt on the buildings. Their income is from interest, and their entire business model is built on using a ton of borrowed cash. Equity REITs are pretty much what you'd imagine when you think of real estate investing. It's a really simple, tangible business, right? You own a building, you collect rent. And because it's all based on long-term leases, the income is generally super stable and predictable. Mortgage REITs, though, they are a totally different animal. They are purely financial. Think of them like banks that only deal with property. They borrow money at a low rate, they lend it out at a higher rate, and they live off that difference, that spread. Their world isn't about tenants and leaky pipes, it's all about interest rates and complex spreadsheets. So if these M-REITs are the ones with those eye-popping dividend yields, where's the catch? Where's all that extra risk coming from? Well, let's pop the hood and take a look at the engine that powers these things, because that's exactly where the danger is hiding. And listen, this isn't just my opinion. A report from the financial firm Edward Jones says it point blank that high yield comes with high risk, and they basically warn most regular investors to just stay away. Let's break down exactly why they say that. It all really starts with this one kind of staggering number, 85%. That's how much of its assets a typical mortgage REIT might be funding with borrowed money. That is a massive amount of what the pros call leverage. And that brings us to risk number one, sky-high leverage. You can think of leverage like a rocket booster. Using all that borrowed money can launch your potential profits into the stratosphere. That's how they pay those big dividends. But if things go even slightly wrong, your losses get magnified just as much. A tiny little dip in the value of their assets can completely wipe out shareholder equity. It's this level of knife-edge risk that explains why the big credit rating agencies usually don't give them a passing grade. Okay, risk number two is that their whole business is incredibly sensitive to interest rates. Just imagine this. You take out a variable rate credit card and you use it to give your friend a 30-year fixed rate loan. Now, what happens when the Fed raises rates? Your credit card bill goes up immediately, but the payment you get from your friend stays exactly the same. Your profit gets crushed. Well, that's the M-REIT business model in a nutshell. When rates go up, their costs explode, but their income is locked in. And that brings us to risk number three. That juicy dividend that got you interested in the first place? Yeah, it's not reliable. Not at all. This chart just looks at the 5 biggest M-REITs over the last 5 years. And check it out. They've cut their dividend 13 times. That is more cuts than raises. That is pretty much the exact opposite of what you want from a stable income investment. So, we've gone through the risks in theory, but what does the actual data say? How have these two different kinds of REITs really performed over the long haul? This is where the story gets really, really interesting. And here you go. This is the bottom line. This data covers a full 15-year economic cycle. We're talking good times and bad times. And the results are, well, they're stunning. Over that long stretch, the boring landlord-style equity REITs, they delivered a solid 6% return every year. And what about those exciting high-yield banker-style mortgage REITs? they actually lost you money. On average, you would have lost over 1.5% every single year. You know, it's the classic tale of the tortoise and the hare, isn't it? All those risks we just talked about, the crazy leverage, the interest rate sensitivity, they're not just theoretical. The data here proves that the hare's desperate chase for that high-yield carrot has historically led to a stumble, while the slow and steady tortoise actually won the long-term race. Okay, so with all of this in mind, how in the world do you decide what to do? Which one, if any, actually makes sense for your portfolio? Well, it all comes down to one thing: understanding your own goals and how much risk you can stomach. This table really just lays it all out. If what you're after is stable, long-term income growth, you're looking at the equity REITs column. The main thing you have to worry about is the overall property market. But if you're an investor with a very, very high tolerance for risk, someone who wants to make a really complex bet on where interest rates are headed, well, then you might find yourself looking at mortgage REITs. And that brings us full circle, right back to the final verdict from that Edward Jones report. Their conclusion couldn't be clearer. For most people investing for the long term, the much smarter play is with carefully chosen equity REITs that are financially solid. At the end of the day, the stability of the landlord usually beats the high-stakes gamble of the banker. So we'll just leave you with this one last question to think about for yourself. When you look at your own money, are you trying to build your wealth like a landlord, slow and steady, brick by brick? Or are you betting like a banker, playing the odds and hoping for that one big payout? Your answer to that question really tells you everything you need to know about which of these, if any, belongs in your portfolio. Thanks for joining this explainer.